Oh, hello there. Now we're going to talk about Bitcoin's next all-time high prediction and matters related to that. So why Bitcoin's next all-time high will matter, when it will happen, what are the likely requirements for it to happen, why it is important when it happens, and what you as a trader might do if it happens when it's supposed to happen. So first off, when will the next Bitcoin predicted all-time high? Well, if you look at the silly nonsense being sputtered around, you'll find that there's a lot of silly predictions, and all of them are basically garbage, for the reason that they're basically guessing using completely irrelevant lagging indicators at best, or puerile chart art. Really, truly puerile, infantile. And you could draw any triangles or circles or squares and throw a dart at it and have just as much of a chance of being right as you could by looking at lagging indicators. What are lagging indicators? They're tools that look at information that's happened in the past with no bearing whatsoever on calculating the probabilities or statistics to the data set, and giving you no information, no insights, no actionable anything in terms of what the probabilities are of the move happening up or down or sideways on the current candle or the future ones. So how can you possibly determine what the future price of anything will be with any degree of certainty if you're using lagging indicators? And the answer is you can't. You need to use leading information. And well, what is that leading information? Well, generally speaking, that leading information is what we call the VEPs, which is volatility, entropy, probability, and statistics. That's why we trade the VEPs at Alpha Trading. Now, why, before I actually give you, and I'm not trying to delay this and be like one of these videos that just drags you on and on, but before I give you the all-time high prediction, I want to explain to you, why does it matter if there's an all-time high on the price of Bitcoin? Well, functionally speaking, as a trader, it really doesn't matter. The only reason that it may matter is if you happen to have long positions open, or shorts, and you don't want to get wrecked, but long positions open to the all-time high, and you want to take profit when it gets at the all-time high. Well, again, how are you going to know if it's the all-time high if you can't predict the next candle? And again, the answer is you can't. You're going to have to guess when it gets to that all-time high. Is it going to keep going up and go to even higher highs, or is it going to break and come back down? Now, you might say to me, but Yasha, Bitcoin is only like 42 grand or whatever. We're like 28,000 bucks or so beneath the all-time high, which was, 69,000 or whatever, depending on some markets, maybe 70,000, whatever. Okay, so you're 25, 26 grand away. That's almost, 50% of the price action, right? Even a bit more. So why should it matter when the next all-time high is if there's so much distance between now and then? First of all, because it's an incredibly volatile asset. And if you don't think that Bitcoin can move, some outrageous amount on a volatile move, you got another thing coming. It could easily happen, right? It doesn't have to happen all at once either. It could just get there very quickly, faster than most people realize. And what happens is usually people will jump on the FOMO train when it's too late, and they'll jump off the FUD train when it's too late, right? So what you should do is to not focus so much on the actual price itself, because again, as a trader, the price is moot. I mean, it's really moot. It really does not matter if you are a low time frame trader, which is what professional traders tend to be. There are very few professional traders working in institutional groups, banks, investment houses, VC funds, hedge funds, whatever, that are trading high time frames unless they're investing. And if they're investing, well, then that's a different story. That's not really active trading. That's putting money into an asset and waiting a long time. It could be years before they decide to cash out, or they expect their returns to cash out, right? So the thing, the thing to look at is not the price action at all. It's in fact the returns, right? And we've spoken about this many times. I keep telling you guys about this if you watch these videos, which I know you're not, but hey, maybe someday in the future somebody will look at this and be like, whoa, this guy revealed a lot of nuggets. Yeah, that's right. So why am I revealing these nuggets? Because like my fellow co-founders at Alpha Trading, I am sick and tired of seeing good traders get wrecked because of poor information. So instead of giving you poor information, I just give you high quality information. And that means probabilities to the upside and the downside and sideways, right? And we look at reasonable targets, good take entry areas, good take profit areas, right? Good areas for moves, good areas for mean reversions, which are a different kind of move, and overall share what is useful and actionable. So why does it matter if Bitcoin hits an all-time high? Again, from a price action perspective, if you're a low time frame trader, it doesn't. If you're a long-term investor, it matters because it means you have more profits in your back, and you should know when to cash out and then make the next move, whether to sell or to, whether to short or whether to just hold your position for the next move, right? But obviously, if it's at the all-time high and you've cashed out and you don't have a position to sell, if you've sold it all, but if you have even a little position, you want to know what to do with it, whether to short it or whether to reposition it for a possible new run up, right? Or just wait a little bit and then figure out what to do with the repositioning based on the information. Either way, you need to know what to do. One of the easiest ways to do that is by being able to read the VEPs. If you can't read the VEPs, you're cutting yourself short, right? And you're undercutting your ability to optimize your profit taking on the returns, which is ultimately what you need to do. But say you're an investor and you're interested in seeing the price go up. Why should it matter when the all-time high on Bitcoin is? Well, it matters because when it is may determine your path to profitability as an investor, may determine whether you want to hold that long or swap for another asset, right? It may determine all kinds of different factors that you might not be thinking of, but probably should. But if you're a proper investor, you definitely should be thinking about these things. If you're just a retail investor and you don't know about these things, and I say just, not condescendingly, but I mean, if you're a retail investor without access to the information that the quote-unquote smart money has, well, you can get that access, right? How? Learn to read the VEPs, right? It's the same information. It's just a matter of whether or not you're using it. And can you use it on higher time frames? Yes, absolutely. And in fact, when you look at the higher time frames of Bitcoin, you can see very clearly that there's going to be a very highly probable all-time high at a certain point. And, before the next pullback and then the next all-time high after that, etc. Why is that? Well, that's because the way that the asset moves, which is basically run on math, right? Computing power, hash power, mathematics of solving blockchains or blocks on the blockchain, that sort of thing. And the way that the actual returns move in terms of volatility and that sort of thing, and entropy and probability statistics, well, that will determine very, very probably when that all-time high will be. Can you say with certainty at exactly what second it will be the all-time high at this point, where it stands is 42,000. Well, maybe, maybe not. Maybe if you know how to read the VAPs, you'll see what the probabilities are that the returns on Bitcoin will be moving in a certain direction at a certain point in time in the future. Well, if you look at the last several cycles of what they're known as the Bitcoin halving, you'll notice that the retail market fell for a lot of tricks that the smart money pulled on them. One of those tricks is to make people FOMO into the rush of the halving, right? And to get them all excited about the halving by telling them, hey, when the production falls by half, the price has to skyrocket. Well, look at the last halving. Is that exactly what happened at that exact moment? No. Right? In fact, at the exact moment of the halving, the smart money took their profits, and since they have bigger bags, the price action went down because it followed the returns down a little bit before moving sideways and then moving up, right? Well, you could say the same thing about the halving in 2016, right? Did it immediately skyrocket, or did it go sideways a bit before going up? Yeah, that's right. It went, even though 2016 was pretty much a bull run, right? It still had its moments of going sideways slightly. So people, and going down even. So people who thought it would just immediately skyrocket once it had the halving, well, they were wrong, right? But did it skyrocket that year? Yes. And did it skyrocket through 2017? Yes. And were those good times to be longing Bitcoin on the long term? Yes. And would you have known if you were already in it back then to take your profits when it hit the 20,000 all-time high, which at the time was 20,000? Probably you didn't. I'm guessing that because, you know, like most retail traders, you probably FOMO'd in at around 19,500, and then when I got to 19.9 or whatever, you know, he said, oh, it's going to go to 20, it's going to go to 21. And then it didn't, because investments by the bigger houses that had finally had the ability to short the market on the day of the all-time high, well, they decided to short the market. And boy, did they. And price fluctuated for a few days, up and down, up and down, up and down, but it never reached that all-time high again. And then eventually came crashing down. And for an entire year, you know, it fell from 19 down to 6 for a very long time, and eventually falling down to about 3K, a little bit more, 3.2K, before moving sideways and then eventually back up. But for an entire year, it was falling until I got to 3.2K. So, what does that mean? Well, it means you can't count, and you shouldn't count, on the FOMO and the FUD. In fact, you should avoid it. How do you do that? Well, you do that by ignoring the hype and ignoring the news. So you don't pay attention to the mathematic significance of the hash power, which is important for the strength of the network, but has nothing to do with the returns on investment that miners and investors and traders are seeing. So you ignore the noise, you ignore the news, you focus on the actual leading information, which is the VEPs. And once you have that information in hand, then you can make an educated, call it a guess if you want, but it's really not a guess. It's a, call it an educated guess, all right, a proper estimate to determine whether or not the probabilities favor the asset going up or down or sideways, and whether or not you should take your profit. As a general rule, if you hit an all-time high on an asset, and you've hit it after already a significant series of moves, generally speaking, that's a good place to take profit. Why? Because it's not going to stay there very long, because people are going to take their profits. If it gets there in an immediate blast and doesn't immediately pull back, it's still, and just sits there, that's also a good place to take your profits. Because if it's just wandering around side to side, then that's generally a good place to take your profits before it makes the next move. Because you'll have real profits in your hand. And so even if it moves up from there, and you didn't get that extra 0.01% or 0.1% or 1% or 2% move, right? It doesn't matter. You've realized actual gains on the move, and you are, in fact, then in a profitable position with more capital in your base than you had before. As opposed to if you are trading and holding the position and it gets to the all-time high and then it snaps back on you and you lose some or most or all of that profitability, then what was that for? You've lost all the benefit of being in that move. You may as well not have been in the move at all, right? You may as well have just, I don't know, gone fishing or whatever you like to do. So the point is that you need to take profits. If you don't do that, you're missing the point of the entire activity known as trading, right? First and foremost, take your profits early and often. Don't be greedy, right? Just take the profits and get ready for the next move. Second, limit your losses. If the move goes against you, get out of it as quickly as you can. Why? Because you don't know if it's going to turn around and go back in your favor. You know, when necessarily, especially if you've made the incorrect decision and it has already gone against you. So, you need to move fast. You can't just sit around and wait on it. If you sit around and wait, I guarantee you one thing, the power of volatility and randomness will see to it that your profitability is taken away from you just as fast. So rather than losing your profit because you were slow, instead, take your profit, even if you know you're probably not going to take as much as you possibly could. That's okay. Leave a little bit on the table. It's all right. Don't leave your stack on the table, but leave open the possibility that it might run a bit further than you take your profit out. Why is that important? Because if you wait for the exact moment where you want it to be at an exact target, you're very likely going to be disappointed when you realize that, wait a minute, that was an obvious target, and everybody and their mother put their targets there, which means everybody and their mother took their profit the moment it hit there, and unless you happen to have the biggest order, you're not first in line, so you're not getting your orders filled until they get to your order, right? Because the order books are usually ordered according to the position size, not just the position in time, but the position size, especially if you're trading on a crypto exchange that is not governed by any rules or regulations, and you are just in the trading Wild West. So rather than be greedy, take your profits at a reasonable area where it gets to a standard deviation or a Laplace distribution, and then you know that's a good place to take the profits because of the probabilities that the price action will not close beyond that within the time frame on the candle you're on, right? And again, you probably want to be trading relatively low time frames in order to be able to make sure that you can maximize your profit taking. Because if you trade very high time frames, you're very likely to lose profits in small measure or medium measure or large measure, because it's a volatile asset. And I'm not just talking about Bitcoin, I'm talking about all of crypto. And by the way, traditional assets are also extremely volatile these days, if you haven't noticed. I mean, even Forex is relatively volatile these days compared to different types of assets, right? Commodities, somewhat stabler, but not entirely. There certainly are days when things like soybeans or wheat or corn or other commodities tend to be fairly volatile. which was less the case some years ago when there was more stability in the Forex markets. But what happened is you got more instability in Forex because of the amount of what's known as BRRR, or infinite printing, right? Infinite money printing by the central banks, right? Places like the Federal Reserve or the European Central Bank or Japan Central Bank or whatever, printing massive amounts of cash in order to stave off debts. But the problem is the more they print, the less it's worth. So they can print more and give everyone the feeling that there's more money around, even though it doesn't actually get to everyone, of course, right? But the problem is that even if they do that, you still have the fact that the money itself is falling in value. The purchasing power of each dollar or shekel or yen or pound or euro is falling for every extra one they're printing. How much? Well, it's proportional to how much they're printing and how much is in circulation. And whatever's being added to the circulation will devalue what's being in circulation. So as they do that, and they do it at different times, you have increased volatility between the assets. And if the US is adding like $1 trillion of debt every year or whatever, then you've got a situation where it's having a more significant effect than before in terms of the cash that's in circulation. That's having an effect on Forex trading. Because what is Forex trading? Foreign exchange trading. It means you're trading different fiat currencies against each other. It could be dollar, pound, shekel, euro, whatever. It doesn't matter. Any two pairs of fiat currencies being traded against each other that are trading at different rates. And again, you can use the VEPs to measure that and see where the probabilities are of those pairs going either up, down, or sideways against each other. And that brings us back to Bitcoin, right? Which people tend to trade, generally speaking, against the dollar. But they also trade it, or euros, or whatever, but usually against the dollar. But they also trade it against other cryptos, right? And even other assets, but usually other crypto. And now that you also have Bitcoin ETFs, which is basically supposed to be a stable way for retail investors to put money into a relatively stable kind of a growth fund, right? That's what an ETF is kind of pitched as, you just invest in the dollar cost average into this ETF, and over time it will grow in value. Well, obviously when you have an extremely volatile asset, that is not necessarily the case. So people who are in ETFs and people who are managing ETF funds are in a particularly different type of situation than they would normally be marketing traditional ETFs that tend to do certain things, because that's why they created those ETFs based on those stocks or whatever. With Bitcoin, it's extremely volatile. Now, does that mean that it doesn't have a good long-term prospect? No, it in fact has a very good long-term prospect. If you look at the last 15 years of trajectory growth, it's gone from 0 to 70,000 in the first 12, 13 years. And then over the last year, it fell down from 7 and back down to 15 and is now back at like 42. What does that tell you? Well, it tells you long-term, just as short-term, it's extremely volatile. Well, what does that mean? It means there are lots of occurrences of opportunity in an inefficient market that is random. And what does that mean? That means as a VEPS trader, you can exploit the ups and downs. You can make money whether the asset is moving up, down, or sideways if you know how to read the VEPs. If you don't know how to read the VEPs, well, then probably your best bet is to not touch the markets and maybe invest in something much safer. Maybe invest in some ETFs if your financial advisor recommends it. Maybe invest in certain long-term growth things. Maybe get some, real estate when it hits bottoms. But how do you know when it hits bottoms? Same thing. You got to look at the market and know the market. You got to be able to tell when the price bubble has popped and sell it when the bubble has inflated again. So there's all kinds of things. Maybe you get some gold. It's not really that exciting, but some people consider it relatively stable. Personally, I don't. I think it's quite relatively volatile these days, and but in small doses. But it's not something you can necessarily count on seeing massive growth on in the future, because there's not necessarily a cap on how much there is, because we don't know how much there is on this planet exactly. We keep discovering more of it. And oh, by the way, even though it's more expensive to mine it on an asteroid in space, at some point it may not be. For now it is. So if we saw, asteroids in space packed with gold, and we know that there are, then great. For now, you'd be better off mining that stuff and keeping it in space and trading it in space and whatever, using it in space. But at some point, there will be a good return on investment to bring that stuff back down to Earth. And you can say, but Yasha, that's many years away. Sure, it was also many years away that Bitcoin could ever exceed $10,000 in price. But it happened relatively quickly once Bitcoin started trading, right? Within, 7 years or whatever, it hit well over 10,000 and continued to climb up to 20, right? And then people thought, well, this exponential growth is great. Maybe it can hit, 50,000. Sure did. Maybe it can hit 70. It sure did. And people have been saying it could hit 70, 100,000, at which point it'll be some kind of a magic number. It won't be a magic number. It'll just be another number, right? And you got to look at the percentage returns, right? So, could it be that Bitcoin hits millions of dollars one day? Yeah, could be. Could it ever hit 100 million? Theoretically, yes. Doesn't mean it ever will, but it could. If it was like, one of the main currencies in the world and all that and used ubiquitously, sure. Doesn't mean it ever will, but it's possible. So, what should you do? And when will it ATH? Well, the answer is very clear. You should know when to enter, know when to take your profits. And to do that, and to know when the ATH is, you have to be able to read the VAPs. And on that note, happy trading.